Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Big progress. President Trump touts positive momentum in the closely watched Japan tariff talks, while China indicates it is open to discussions if the U.S. shows respect.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent.
U.S. stocks decline after Jay Powell maintains a wait-and-see stance on rate cuts amid trade war uncertainty, dashing hopes of a Fed put. And Rome Roundtable, the U.S. and Iran prepare for a second cycle of nuclear talks, but Tehran warns it won't negotiate on its ability to enrich uranium and will walk away if the Trump administration moves the goalposts. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Markets saw a bit of a double whammy yesterday. We walked in, remember, this time 24 hours ago with news that the Trump administration had curbed the chip exports, the specific chips of NVIDIA to China, those H20 chips. And on the back of that, the market was poised for a negative open. And indeed, that did transpire throughout the course of the day. NVIDIA chips dropping as much as 7% throughout the course of the day. But then later on, a lot of attention was paid to Chair Jerome Powell's speech, where he sort of said that they're going to keep a wait-and-see approach to the dynamics with the U.S. economy, not really hinting that they're going to act anytime soon or implement this Fed put that people have been hoping for, i.e. these insurance rate cuts. Instead, quite cautious on the outlook. So on the back of that, we saw risky assets take a bit of a tumble. The S&P ending the day down more than 2%, NASDAQ down more than 3%. Obviously, those chips, NVIDIA, leading the declines yesterday. But today, what we are seeing is some stabilization come through. S&P futures, NASDAQ futures pointing towards the green. The handover from Asian markets has been pretty positive as well. As we talk about progress, perhaps, on the deal making, we'll speak to Jill shortly about what's been happening between Japan and U.S. on the trade front. But today, things stabilizing. 10-year yields continue their march downwards. So today, we up around 3 basis points. Yesterday, throughout the course of the risk-off day, we did rally about 5 basis points. So again, tells you that at least this part of the market seems to be stabilizing as well as we get towards the end of the trading week. And then euro, all eyes on the euro today. We are trading a little bit weaker versus the USD. So the USD gaining ground for a change. But today, we've got the ECB meeting. The market's at price for 25 basis point cuts at this meeting. But I think once again, the focus is going to be on the language to the future and whether the ECB hints that another rate cut may be coming as well. This chart I thought was really interesting because take a look at what's been happening with the currency and yield differentials versus the USD. For so long, they've been very closely correlated, i.e. when you see European rates rally, you also see the euro come under pressure. That hasn't been the case recently. And I would say that is more of a dollar story because the dollar has been heavily sold into, money has been coming into the euro currency, even though traders are pricing in more and more rate cuts out of the ECB. So that divergence, I would say, is pretty stark and interesting as a setup going into today. Right, President Trump says negotiators have made what he calls big progress in a meeting with Japanese officials seeking a deal to avoid higher levies. For more, let's bring in News Desk editor Jill D. says, Jill, just get us up to speed on how these trade negotiations are going and what concessions Japan are willing to put on the table in order to get a deal across the line, because this could be sort of a template for other countries around the world.
Yes, Jumana, that's certainly the big question here. So first of all, just want to caution that while there were obviously talks that happened on Wednesday in the U.S., including President Donald Trump was parts of those talks, as he indicated that he had been earlier, we don't have a full trade deal in place yet. So again, as you said, Jumana, these talks are being looked at as something that could be a template for other nations, particularly key U.S. allies, to kind of come into the picture and, actually, discuss something here. But we don't have a ton of clarity yet on what this ultimately looks like. They did walk away from the table saying that they expect that there is going to be a future meeting sometime soon. The Japanese Prime Minister Ishiba also indicated that he might be willing to travel to the United States. So there's certainly a lot of, chatter on both sides here about getting something done. But remember, Jumana, there's quite a lot that Japan is really contending with here, in addition to the 24% reciprocal tariff that the United States placed on Japanese goods. That was the one that was delayed for 90 days. They're also sort of subject to a lot of these larger sectoral tariffs that the United States has put into effect. So that's the 25% autos tariffs along with those aluminum and steel tariffs. So there's certainly a lot here that they need to discuss before they actually get to an agreement.
Yeah, particularly automakers and pharma in focus for some of those key Japanese sectors. Let me also just ask you about another story on our terminal that I saw in the last 24 hours. And I thought this one was quite interesting, in that the Trump administration is also apparently putting pressure on some of their allies to also curb their own trading with China as well, so that it's more like a group approach to trading with China as opposed to U.S. going at it alone. What do we know about this story?
Yes, that's right, Jumana. And I think that this kind of gives us a little bit of insight into what the Trump administration might be trying to strategize when it comes to actually negotiating some of these trade deals. So what we've learned is that part of the approach that the Trump administration is taking is essentially trying to pressure a lot of those nations that are seeking reductions or exemptions from these tariffs into, sort of pressuring China themselves. So imposing so-called like secondary tariffs. So that's essentially a monetary sanction on China. Maybe they would, impose additional, punitive measures, to prevent, these countries from, taking in excess goods from China. So essentially the strategy here is that if you want to come to the table with the United States, if you want to talk about these tariffs that we've put on you, is there some way that the United States can then exert pressure on those countries to sort of, reduce the amount of trade that they're doing with China in order for the U.S. to get what it wants, which is to really kind of maximize that amount of pressure on China. Of course, how successful this approach may be, I think certainly a lot of questions there, but it does kind of give you that idea that the United States going into these negotiations with its trading partners really is, looking to sort of maximize that economic pain that China may feel.
Yeah, and the irony, of course, is that President Xi himself is right now engaged in a tour around Southeast Asia. As you were speaking, we're just showing some live images of President Xi landing in Phnom Penh in Cambodia. Yesterday, we were speaking to Avril Hong about his visit towards in Malaysia. And what he is trying to do is to forge closer ties with some of these Southeast Asian countries that have also been hit by the tariffs as well. So these are live images now of President Xi expected, he's arrived in Phnom Penh, and we should see images of him emerging shortly as part of this trip in Southeast Asia. Now, Fed Chair Jerome Powell has dashed hopes of an early rate cut in response to the Trump trade war, signaling a wait-and-see approach on the impacts.
For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals.
Well, joining us now is Peter Schaffrik, Global Macro Strategist at RBC Capital Markets. Pete, I am going to talk about the ECB, but let me just ask you about your impressions of what you heard from the Fed Chair Jerome Powell yesterday. I feel as though the market is a little disappointed. At least the reaction would suggest that people wanted to see a more dovish Jay Powell, and they just didn't get that yesterday. He didn't give in.
I think that's absolutely right, but it is also consistent. The Fed, Powell himself, have said more or less the same thing before. What you have with the Trump tariffs is essentially a small stagflationary shock, where you have pressure on the economy downwards, but also pressure on inflation upwards. And whether or not that's transitory remains to be seen. But for the time being, the Fed is taking that into account. And the result is what you heard.
Yeah, but the ECB seemed to be in a different situation because they've had a real rapid strengthening of the currency. They've got an ongoing disinflationary process. Services inflation has surprised to the downside recently. And so you could say that it's easier for the ECB today to sound unambiguously dovish, which is a different situation than the Fed are in.
I think that's right as well. When you think about it, the countries that are imposing tariffs, in that case the US, have a much higher probability of prices going up, whereas the countries who are on the receiving end, they probably feel much more of the economic downdraft. And that's exactly the situation that the Europeans find themselves in. And always worth keeping in mind, the ECB was probably, even before the onset of tariffs, bound for another rate cut. There was a question about whether they would.
Oh, we appear to have lost some of Peter's sound. Let's just see if we can reestablish connectivity with him. While we do that, this is just where fixed income is trading right now. As I mentioned earlier on, this has been a big point of focus for the market. 10-year yields are stabilizing, but Peter seems to be back again. Peter, I'm just going to pick up on where you left it. We briefly lost the audio with you. Some people have been talking about a potential change in language. And remember, back at the March statement, they removed the statement saying that policy was restrictive, instead said that policy was meaningfully less restrictive. Are you expecting a tweak in language here for them to perhaps sound more or less dovish to help them convey the overall message to investors?
I think they almost have to, because when you think about it, their definition, or not exact definition, but their findings about where the neutral rate of interest is somewhere between 175 and 250, and now they would be moving below that. So they will probably have to tweak the language a little bit. I mean, it's not entirely clear what they will say, but I would expect something like it's uncertain whether policy is still restrictive or something along those lines, to just symbolize that after the amount of rate cuts that we've seen, they're now in a position that is much closer to neutral, without probably saying so exactly.
Peter, I was just admiring your beautiful Bloomberg terminal in your backdrop. So let me ask you a question based on our WIRP function, giving it a bit of a plug here. The market is pricing in about 3.5 rate cuts in the ECB curve from now until the end of the year. Do you think that is valid? And what do you think it would change what the market is pricing in today?
So maybe not today exactly, but I think what's going to determine where they will end up, and that's what you're referring to, as the terminal rate eventually, in my mind, is really what's going to happen with the Trump tariffs and how that's going to develop. Because clearly, if we go back to a situation where a lot of tariffs come in, and then there's the threat of counter tariffs, the potential to widen sort of the trade war into services, that's clearly negative. We got a negative shock already. So, and if we go there, then I think it's more plausible that the ECB will indeed end up at levels that would be below this 175 lower bound of where their neutral level or neutral zone is that I mentioned earlier. Without those, if we assume a more, if you assume something a bit more amicable, then I think it's probably a stretch.
Yeah, Peter, just final question for you. Look, tariffs, obviously growth negative. The fiscal spend from Germany, growth positive. Do the two cancel each other out? Where do we end up? Where do we end up in this equation?
I think in principle you're obviously right, but what we do know is roughly what the size of the fiscal stimulus is. What we don't know is what the size and the impact of the tariffs are, and that's also very, very uncertain. Not only what will come in, but also what the impact is. The ECB has, or Lagarde has suggested 0.3 to 0.5% negative. If that was indeed the magnitude, then they probably would cancel each other out. But if we go into a much stronger counter-tariff situation, I think the impact could be even larger. So that's very uncertain. And I think the ECB wouldn't know at this stage either, and they will probably try to play for time when they come to make that decision.
Yeah, very clear. Peter, great to chat to you. Thank you so much for getting up early for us.
Thank
Peter
you.
Schaffrik, Global Macro Strategist at RBC Capital Markets. Now, still ahead, we check in on the multiple headwinds facing the tech sector as the U.S. dials up the pressure on China. Wedbush Securities' Dan Ives gives us the outlook next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, U.S. chip stocks had a rough day as new curbs on NVIDIA sales to China and a disappointing report from ASML dimmed the outlook for the sector. Joining us now is Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. Good to have you on the show, Dan. Let me start with the price action in NVIDIA stock yesterday. We dropped almost 7% in trading after news of these curbs came out. First of all, do you think that reaction is warranted? And how much of an impact do you think these H20 chip curbs are actually going to have on NVIDIA's bottom line?
Yeah, look, I think it's warranted because ultimately, I mean, you're looking at number cuts that are probably going to be 10, 12% when it's all said and done. And I think it's less about this in terms of the financial impact, it's what the ripple effect. This is essentially a do not enter sign that's in front of China, from the White House. And it's NVIDIA, of course, AMD and others. This is just the first step, I think, that we're seeing, just the massive trade tariff war that's been a gut punch to tech.
Yeah, but Dan, at the same time, what we have seen is that carve-out for consumer electronics. It's temporary, but it seems as though the administration has been listening to the likes of Apple and trying to buy a little bit more time to help them reconfigure. Will we see a similar type of carve-out, do you think, for NVIDIA, or has that ship sailed?
Yeah, I think that ship sailed. Look, I think NVIDIA itself, and Jensen, he'll talk about it, over the coming months, I think they were caught by surprise. And I think the reality is that no one knows the rules of the game. And I think that continues to be the issue here. What we're talking about now, could that change in the next hour? Yeah, it's possible. And I think that's set in stone, this sort of avalanche effect in terms of uncertainty that's cascading down. That's why I think we're going into an earnings season. No company's going to give guidance. I think number cuts are basically 10, 12% across the board. You need to be able to look past the storm and hope that we're going to have negotiations soon with China cooler heads prevail.
Yeah, I mean, you just said China's become a no-go zone or do not enter market, I think you said. Ultimately, can you see a full decoupling of U.S. tech from the China market? I mean, is it actually technically feasible?
No, let's talk reality. It's not possible. So I think investors, look, if investors really thought that, stocks are down much more than they are today. I mean, the market's basically pricing in at one point that, these sort of two bullies in the back of a schoolyard, someone's going to have to blink. And you're going to have to get to some sort of negotiation process that could take time. But reciprocal tariffs in their current form basically cannot exist, in terms of the 145 or 245%. And look, when it comes to tech, U.S. tech's caught in the storm. Investors are caught in the storm. And I could tell you, in 25 years doing this, dot-com bubble, financial crisis, it's the scariest time that I've ever seen, especially for tech investors.
Yeah, that's pretty damning. I've got to say, in all the times that I've spoken to you, you've been pretty upbeat and bullish on the sector. So it really is quite significant for you also to sound so bearish on where we go from here. Is there any scenario under which tariffs are applied or Section 232 type tariffs are applied and tech can still perform well?
Look, I think it comes down to go back to pre-Liberation Day, okay? 15, 20% was always the view of reciprocal tariffs. And if that happened, market right now, you're looking at NASDAQ, 15, 20% higher. The reality is that the tariffs in their current form are untenable. They need to be manageable to a point where some could be passed down, some could be eaten, but ultimately you cannot have numbers these high because essentially it causes a shut-off valve for U.S. tech and for the consumer. And that's been our whole point the last few weeks. Let's talk reality versus fairy tale that sounds good in front of the microphones. Supply chain is in Asia. It's hard to belong to the U.S. supply chain. You could have some onshoring, but the reality is that, it would take Apple 3 years to move 10% of its supply chain. That would cost $30 billion. So let's just talk reality, and I think that's what companies want to talk about.
Okay, a final question for you. Our Bloomberg intelligence analyst, Robert Lee, put out a note yesterday that saying that, ironically, on the back of this and on the back of these curbs, China could actually get a leg up because what it forces is subscale firms in China to leave the market. Though there's going to be short-term disruption, some of the bigger names already have ample supply of chips, and they'll be forced to innovate, to invent their own chips so that they become even more autonomous from the U.S. Do you buy that view?
Our whole point is that for the first time in 30 years, U.S. tech's ahead of China. And what you're essentially doing with these tariffs, you're cutting the knees of U.S. tech, sending it back years. Guess who wins? China tech. And I think that's the reality of what this twilight zone we're living in, where U.S. tech and investment have been caught in this Category 5 storm.
Yeah, Category 5 storm. Okay. That's a good place to leave it. Let's see what the weather gods bring us. Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. Thanks for staying up late for us. We appreciate it. Now, coming up, Lesotho tries to negotiate with the U.S. as it warns Trump's higher tariff rate would be devastating for the tiny African kingdom. We hear from the country's trade minister later in the program. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Well, we are keeping a close eye on some of the footage that is emerging from Southeast Asia. And these are live pictures from Phnom Penh in Cambodia, where President Xi's plane has officially landed now. We're waiting for him to exit the aircraft. And this is, of course, part and parcel of the trip that he's been making around the Southeast Asian region. Yesterday, we spoke to Avril Hong. She was reporting live from Malaysia. He was in Vietnam as well. And all of this part of their emphasis and focus on encouraging more regional trade as a direct consequence of this trade war that the U.S. started a couple of weeks ago, or I should say at least accelerated a couple of weeks ago. So these are live images now. We're expecting President Xi to emerge at any point in the next few minutes. And part of this trip is really to help foster closer trading ties amongst China and the countries surrounding it. And this, again, it ties in to a report that we put out yesterday. Well, there you have it. President Xi has just emerged from the plane now, waving to people who are waiting for him, waving some flags. And this is in Cambodia. And really a strategic visit on their part, given the economic developments over the last few weeks. And as the trade war with the U.S. has most definitely taken a turn for the worse. But the big question, of course, for China is whether they can actually find other markets for their exports. 30% of their GDP came from the export market last year. Will regional trades compensate for the loss of some of those markets in the U.S.? That's a big question. But we'll leave you with images of those pictures. When we come back from the break, we're going to talk about oil and OPEC Plus output. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Big progress. President Trump touts positive momentum in the closely watched Japan tariff talks, while China indicates it is open to discussions if the U.S. shows respect. U.S. stocks decline after Jay Powell maintains a wait-and-see stance on rate cuts amid trade war uncertainty, dashing hopes of a Fed put. And Rome roundtable. The U.S. and Iran prepare for a second cycle of nuclear talks, but Tehran warns it won't negotiate on its ability to enrich uranium and will walk away if the Trump administration moves the goalposts. Well, it's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai, getting you up to speed on markets. Yesterday, we had a bit of a double whammy. Remember, 24 hours ago, we were talking about the news out of NVIDIA that the Trump administration had imposed curbs on their H20 chip exports to China. They then said that they were going to take a $5.5 billion write-down on the back of that. Later on in the session, AMD also saying that they're going to take an $800 million write-down as well on back of exposure to China. And so what you got was was a chip-led sell-off in the tech space. The Nasdaq pulled back around 3% yesterday in trading, but it didn't just stop there. You also had Powell as well, and perhaps disappointing to some in the market who were hoping he'd sound a bit more dovish or willing to act or willing to implement this Fed put. Instead, he just went for a wait and see approach, emphasizing that they have two parts to the mandate. It's not just unemployment and maximizing growth, obviously, but the inflation rate as well. And so he did, for some, sound a bit more hawkish than the market had been hoping for. So also that led to some declines in the S&P. We ended up much weaker by the end of the session. Today, though, stabilization coming through. We've got both S&P futures, Nasdaq futures leaning up about 0.8%. A better handover, I should say, from most of these Asian equity indices as well. 10-year yields back to 4.3. We're about 3 basis points higher, but we did rally about 5 basis points yesterday throughout the course of the day. So the trend over the last couple of days has been yields lower, but moderating somehow today around 4.3%. Many people in the market are saying that a lot of that deleveraging, the deleveraging out of the hedge fund community, those basis trades that moved against market participants have, for the most part, been unwound. But again, there's some cautiousness in this part of the market because we know that Trump and the Trump administration are watching the developments in bond markets very closely. So keep an eye out there. And then ECB today, big day. They are most likely going to cut 25 basis points. That's what's priced into the market. But again, the statements will be pieced very closely for any change in language around the word restrictive or marginally less restrictive, in addition to some commentary about how they're thinking about the possibility of further interest rate cuts and whether June will also be a live meeting. But today, the euro is slipping versus the USD after a very good run the last 2 weeks. We're 0.3% weaker. This chart I thought was interesting because it shows the divergence between where the euro is trading versus what interest rates are pricing in. So the white line is essentially tracking the differentials between European rates and U.S. rates. And that has moved a lot wider, i.e. U.S. yields are much higher than European yields as the market accounts for a more aggressive interest rate cutting cycle out of the ECB. But at the same time, money has gone into the euro. Typically, you'd expect the euro to decline when interest rate expectations decline. That hasn't been the case. Why? This is a dollar story. The market has been deleveraging or de-dollarizing, I should say, moving money away from U.S. assets, and some of that has gone into the euro. So you've seen a bit of a breakdown between the relationship of FX and rates, and I thought that was an interesting chart to flag as we head into this meeting. Now, Iran says it won't negotiate with the U.S. over its ability to enrich uranium, warning that shifting parameters could risk talks falling apart. The two sides are due to meet in Rome this weekend for further discussions on Iran's nuclear program. Iranian officials expressed frustration with contradictory positions from their U.S. counterparts, including a demand that Iran stop and eliminate its nuclear enrichment and weaponization program. Let's take a look at how oil is faring. Oil is actually trading higher for a second day after the U.S. said it would reduce Iran's energy exports to zero. Now, as part of efforts to disrupt the OPEC members' oil supply chain, Washington has sanctioned a second Chinese refinery accused of handling Iranian crude. Meanwhile, OPEC Plus is making a fresh push for members to compensate for exceeding their oil production quotas. Let's discuss all this and more. So much going on with Sara Vakhshouri, president and founder of SVB Energy International. Sara, maybe let's just start with the price action that we've had in oil over the last couple of weeks, because we are actually trading next to 4-year lows now. Yes, we've seen a bit of a bounce the last couple of days, but Brent was getting closer and closer to that $60 mark. And we've seen many think tanks, many outfits downgrade their estimates for oil demand growth over this year and next year on back of the potential impact that tariffs could have to the global economy. Do you think at around these levels, so close to around $65 for Brent, that trimming to the demand outlook has already been sufficiently discounted?
Well, it's a good discussion to start with, the impact of tariffs on demand. As you mentioned, most of the major, at least data-producing organizations, both IEA and OPEC, reduced their demand expectations. Also, it's very important to note that it's not just the impact of tariffs on the demand that is impacting the market, but if we look closer, we see that the spread between the light and heavy crude oil, or Brent and Dubai-linked oils, is reducing and narrowing. And something that happened in April was that the EFS spread, or the spread between the two major crude quality and linked crudes to them, is narrowing, which basically means that the major producers at the OPEC and Gulf producers are losing their advantage somehow to the lighter crude oil. So there are a lot happening.
Yeah, interesting. I also want to draw your attention to a quota, OPEC Plus quota, that was published yesterday. And it's interesting there because remember when OPEC Plus surprised the market a couple of weeks ago, and they said that they're going to accelerate bringing extra barrels to market. But at the same time, the understanding was that there would be some discipline instilled in the group to ensure that other members were not overproducing. Yesterday's data has showed that Kazakhstan are massively overproducing versus what their quota is. And there's been only marginal improvement for the likes of Iraq and Russia. So long as these other OPEC members continue to overproduce, how difficult is it going to be for OPEC Plus to keep a tab on prices?
First of all, I want to mention that it's remarkable that how, especially in this environment of uncertainty, that most countries are putting their economic advantages first, can still keep the alliance going on. And the fact that just yesterday we saw that compensation schedule coming out, then even the verbal commitment that these countries are putting, it's itself very important at this environment particularly, and shows that the organization still is aligned and they're working into that the 3P strategy that Saudi Energy Minister always mentioned and referred to, that they have been very cautious. And while, yes, they are trying to, they surprise the market by increasing their production increase plan, accelerated more than it was expected, which again, I mentioned, it's important for them not to increase their market share, but to defend and maintain their market share, not just because of the lower demand, but also because of this narrowing the spread and increased spot selling in the market. So it's very important for the organization. But if we look at the compensation schedule and comparing it with the amounts that OPEC is going to increase the production, the difference is very minimal. And also, it's very important to note that as we are heading to the warmer season, most of the producing countries, especially in warmer environment, are going to consume more oil. So they have been very cautious. And unlike many of the assessments or expectation in the market that are always looking at OPEC as a price-setting club, and they're always trying to interpret OPEC's decisions into which price goal OPEC had. It has been really a risk management alliance, particularly since COVID, that in the height of every unpredictable and uncertain market environment that we had, OPEC alliance has been trying to somehow adjust its production by managing the risks in the market.
Yeah. Sara, I want to round up the discussion with the question about the Energy Secretary, Chris Wright's visit to the region and to Saudi Arabia. There was a lot of excitement over the weekend about the potential for a nuclear deal with Saudi Arabia. And the timing is interesting, of course, because all of these U.S.-Iran discussions are going on. But what do you make of the news that came out, and the fact that Saudi Arabia may also be looking to launch their own nuclear program with the blessing of the United States?
This is a very good point. I remember both of us around a month ago, we had this discussion referring to one of the reports in the market that was arguing that since Saudi's oil export is reducing to U.S. and U.S. is producing more oil, the relation between two countries is somehow decreasing. And I think this was very interesting because if you look at the itinerary of U.S. Secretary of Energy to Saudi, it was a very warm welcome. And they visited Dammam well number one, which is interesting because usually well number 7 is more celebrated among, in the oil industry, because that was the first commercial well. But they visited well number 1 in Dammam, which kind of reminds, it's a historical reminder, very meaningful reminder that perseverance, not giving up, and the trust that the two countries have in each other at the both time of height and low, how hand in hand they have been patient and working together, and kind of a nod to a new chapter that it was mentioned by U.S. Secretary of Energy, potential civil nuclear power generation agreement between U.S. and Saudi Arabia. So moving beyond oil, but into a new chapter. So I found it very meaningful, the visit, and particularly the places they visit, the type of welcome that U.S. Secretary received.
Yeah, I saw that post on X as well. I thought it was quite a significant moment too. Sara Vakhshouri, thank you so much for coming on. President and founder of SVB Energy International. Now, the Israeli military says it is preparing to expand the area of its ground attacks in the Gaza Strip, seeking to tighten its grip as hope fades for a new truce. Israel's defense minister says troops will now remain indefinitely in so-called security zones in Gaza, Lebanon, and Syria. The IDF says it has turned 30% of Gaza into a buffer zone as it presses its military offensive, vowing to maintain its blockade on humanitarian aid to the territory. And coming up, Lesotho warns that Trump's paused higher tariff plan would lead to a liquidity crisis as it continues its negotiations with Washington. We hear from the country's trade minister next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. The tiny southern African kingdom of Lesotho warns it is at risk of a liquidity crisis if President Trump follows through on plans to impose a 50% levy on the country's imports. The Trade Minister Mokhethi Shelile told Bloomberg that negotiations with Washington are ongoing, but says it remains unclear what non-tariff barriers need to be removed.
They should be in a position to advise us what else they find it difficult for themselves to establish in Lesotho. It could be anything, really. For instance, there have been some suggestions that we should be buying certain things from them in terms of grains. We buy quite a lot in South Africa, and it's very affordable, and we would like to keep that market. But we have to understand if there is any problem for them accessing the market that could be non-tariff related.
And I wonder, Minister, when you and the rest of the government there, the country, heard about this 50% tariff initially, did you run the numbers? How could that potentially affect the economy if, in fact, it does stay after the pause?
Yes, we have run the numbers. Directly on the far line is 12,000 jobs that we have here. Which is going to now, at the end of the day, translate to further 40,000 jobs. That depends on the 12,000. So we will be terribly affected. We are going to have liquidity issues in terms of foreign currency. We have a good 6 months cover, which is very comfortable, but that situation will change. We have projects here with South Africa, where we are building huge dams that require a yellow plant, for instance, material from countries that we have to use the dollar to buy from. We are buying electricity from Mozambique to supplement what we have here, and we use the dollar to buy that. So the issue goes beyond what anyone can think it's possible.
That was Lesotho's Trade Minister speaking to our Chief Africa correspondent, Jennifer Zavazajja, who joins us now from Johannesburg. Jen, great get. Also, I remember when this reciprocal tariff chart came out, everyone was shocked that this tiny kingdom of Lesotho was going to be subject to a 50% reciprocal tariff rate, where the EU were subject to 20%. And now they're forced to engage in discussions with the US to try to come up with a deal. What's on the table?
Right, Jumana, similar to what the minister was saying, they were quite caught off guard, especially because if you remember, we heard from President Trump when he first made his address to Congress, invoking Lesotho's name, saying that he wasn't sure what the country was. Now they had become the country with the highest tariff imposed on them globally. And so this has really been a surprise. He said that they have been scrambling to try and figure out what to do. They had initially planned to make a trip to the U.S. Last week, but have not been able to get a meeting. So at this point in time, what is on the table is potentially they have a meeting next week in Pretoria here in South Africa to talk to U.S. officials about some of the concerns that they have. He mentioned tariff and non-tariff barriers, but he also made it a point to reiterate that this country does not have too much to compete with in terms of some of the other countries that are sitting at the table and offering maybe some mutually beneficial trade negotiations with the U.S. This is a small landlocked country surrounded by South Africa, reliant very much on the its economic activity is reliant on South Africa and Mozambique. And so potentially they need to look at those and really put on the table what can be done here, especially because over the past 25 years, this country has enjoyed relatively low to no tariff because of this trade pact called AGOA. And so it really is a concern. What was actually a bit surprising, though, Jumana, is that the minister did say it would be comfortable if this 10% baseline stayed, because it could make them competitive and compete with other countries like Kenya and others on the table. But still, there is a lot that they plan to at least try to sit down with U.S. officials and talk through.
Yeah. But honestly, just looking at the numbers, it's really difficult to get one's head around this. The trade surplus that Lesotho enjoys with the U.S. is $235 million compared to $170 billion that the EU has. These are tiny numbers, so it really is remarkable that the U.S. has chosen to pick a fight with them. One thing that I do want to ask you, though, Jen, the kingdom just granted access to Starlink a few days ago. Does that have anything to do with the timing of these discussions that are taking place? Obviously, Starlink, Elon Musk, is there a connection somehow?
That's what we wanted to ask the minister. He did say that there wasn't any correlation with the timing, but it is interesting, and it does sort of beg the question as to what do they have to put on the table. The real facts, though, here, Jumana, are that Starlink had applied for a license over a year ago, just about a year ago, and just now were granted this license. The minister told us that they do need this accessibility because, of course, they are a landlocked country. But, he wasn't shy to put forward that he does hope that other companies, come to the table and potentially ask for negotiations and potentially licenses to come into the country. Potentially that could make negotiating with the U.S. a little bit easier. But, of course, as you mentioned there, the correlation with Elon Musk and Starlink is one that we couldn't really ignore.
Yeah. Jen, thanks for the reporting and great get the interview. Jennifer Zavazajja, our Chief Africa correspondent in Johannesburg. And for more stories like this from the continent, be sure to subscribe to the Next Africa newsletter on the terminal and our website and our podcast, available on Apple, Spotify, or wherever you get your podcasts. This is Bloomberg. Turkey is set for a tricky interest rate decision later today when the central bank meets. That's after the arrest of President Erdogan's biggest rival and the onset of a global trade war that sparked a market rout. For more, we're joined by our Turkey Deputy Bureau Chief, Beril Akman. Beril, I've seen various notes put out by analysts. Most people think that the central bank will stand put, but some, a few lone voices, think they may actually have to hike interest rates. What a turnaround in the last few months.
Absolutely, Jumana. Just like you said, it's a very tricky decision for the central bank today, with the lira being at the forefront of the argument on what it's going to do. Most of the analysts do expect a hold to the policy rate, the main rate of 42.5%. But that definitely comes with some caveats, because last month in an emergency meeting, the central bank actually suspended funding from that policy rate and increased the secondary rate, the overnight lending rate, of 46%, and has since been using that rate. Now, some controversy today or complication arises from that, whether the central bank is going to preserve that status quo but still use that upper bound, 46%, to continue funding, or whether it's going to actually hike its policy rate to potentially that rate. And we have seen over the last few days some analysts pushing for that, for a return to conventional funding methods. But the central bank has drained about $50 billion of reserves last month. So definitely the decision will be very significant today in terms of what happens regarding the currency and whether locals continue to stay in liras. We have seen some inflows to FX deposits. So it's a very crucial decision today.
Yeah. And what is the latest regarding the political situation and the Istanbul İmamoğlu situation right now?
So Istanbul Mayor Ekrem İmamoğlu, who runs a city of 16 million people, Turkey's largest city, remains in jail. He has been since last month after his detention and later formal arrest on corruption charges. He's pending trial, and we have yet to see the indictment yet. Him and his main opposition party have called the decision political and has blamed President Erdogan and his government for barring İmamoğlu from running in the elections. We have seen some protests continue from the opposition, and they are vowed to continue the momentum.
Yeah, a Bloomberg Turkey Deputy Bureau Chief Beryl Akman with the latest on Turkey. Thank you so much. Well, that rounds up our show, Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. We're off tomorrow, but we'll be back on Monday. For those celebrating, have a wonderful Easter weekend. This is Bloomberg.